Sarah, it's 9 o'clock.
Okay, well, good morning, everyone. Welcome to our Finance and Audit Committee meeting. We have a full agenda, one resolution and several reports, including audit reports. So over to Huz. First we have a roll call for attendance.
Very good. I do want to let folks know that we are live streaming and recording this meeting. Both of those have already started. Jerry Abrahams.
Here.
Phil DeFranzo.
Here.
Timothy Hodges. Catherine McKinnon.
Here.
Commissioner Perez. Franklin Perry.
Here.
Chelsea Ross. Sarah Sanders.
Here.
We do have a quorum in attendance for the meeting.
Be good. Over to Hazim for the allocation of state carry forward.
Good morning, everybody. Happy January. Finance, we do have one resolution that we would like to present to the full board this morning. The resolution pertains to the allocation of the state carry forward private activity cap. Last December, the State Bond Commission awarded CHFA 11,518,800 of unused 2024 private activity bond volume cap. To preserve the award, the Internal Revenue Code requires us to file a carry forward application by February 15. We are recommending the approval to carry forward 100% of the award to homeownership. In addition, on December 19, the Census Bureau released the state's 2024 projected population number, which was higher than the prior year. The increase impacted CHFA 2025 tax-exempt volume cap allocation and the 9% low-income housing tax credit calculation, and therefore the lending plan has been updated accordingly. I'll be happy to answer any question regarding the resolution.
I was wondering if we could look at the lending plan schedule. I thought that was interesting.
Sure. Lorraine, can you go to the...
Okay. And one of my comments was, someone in my office said to me, the word is that CHFA focuses much more on single family than multifamily. And so this is kind of interesting because it shows that we do have much more of our assets in our lending plan to single family versus multifamily. Do you know how we compare to other HFAs? Is that true that we are more tilted towards single family?
I think it depends to how each state would deploy their resources. So in the case of CHFA, when we come up with a lending plan, the intent was to come up with a baseline. So what we present to the board as part of the budget presentation was to establish a baseline. So in the case for multifamily, we established a baseline of utilizing at least 100 million for multifamily, and that's been the general issuance that CHFA does on an annual basis. Having said that, the lending plan is not supposed to remain static and is fluid. Therefore, over the course of the calendar year, we have the ability to adjust and allocate resources depending to the readiness of a multifamily project to close. So we can say that we want to spend more on multifamily or spend more on single family, but at the end of the day, it all comes down to whether or not applications in the pipeline would be ready to close. So it is more to do with setting a baseline, but making sure that resources will be available to fund any loans that have closed so that we can deploy them as efficient as possible.
Well, I was looking more at the overall bottom line, total program budget, which, you know, is the big picture. And I just see, you know, it's about 900 million for single family and 400 million for multifamily. So I was actually out talking more bigger picture about, is it true? Do you think that CHFA is a little more tilted towards single family than multifamily compared to other HFAs?
Yeah, so
Well, I think part of it's the market conditions or the market environment, so in other states, it would depend on how, you know, if you're saying how do other states do it? So in other states, you know, so in our state, Connecticut, because of time to own, we have been in the unique position and with tax exemption available, even though Kazima's done an amazing job of blending taxable and using refunding to expand our borrowing authority. With the rising interest rate environment that we've had, now it's changed a bit, we've been very competitive. And, you know, that lending that would otherwise go to conventional lenders has become available to the state through its time to own program, as well as CHFA through its first mortgage program. Multifamily is not quite the same animal because it's, each deal is very unique and is, you know, as you know, it comes together with a blend of all of these different types of sources, the availability of land and all these other factors, right? So it's really crafting a different product versus single family where if there's inventory and the other conditions are right for, you know, first time home buyer program, you can create the demand and you can meet that requirement in the market. So I think it varies by state. I'm pretty sure that some states are very similar to us. Some states do only single family. They have no multifamily program at all. We're one of the few states. I think we're one of 10 housing finance agencies out of 50
Wow.
that have. Hello?
Oh, Sarah's agreeing with you.
Oh, okay.
I just said, wow.
I'm sorry. That have multifamily first mortgage programs. Most of the other states either do not have any, or they do conduit issuance, which just means that another lender is taking the risk and doing the lending. So yes, I mean, we would love to do more multifamily, but as Azim was saying, it really varies depending on who's ready to proceed and all of those things.
Okay, Commissioner Perez, you have a question?
Yes, and I think Nadine touched a little bit on what I was going to say about market conditions. So I want to ask the question a little different. Demand-wise, do we have a greater demand for multifamily than when we serving? Because I will argue, without knowing any, doing any research, but knowing the major players, that probably the demand is not there because the Randys of the world and the other people who are doing a lot of those big projects in New Haven want to do market rate, which are not the type of stuff that we would normally, you know, fund. We will want some low to moderate income numbers. So I was just curious.
Yeah. So
Because one thing is that we want to do it, and another thing is like Nadine was saying, the market, right?
yeah.
We're not in New York, so a lot of people here want to be homeowners, right?
Right. I think like one thing I will add, Commissioner, is when it comes to demand, there will always be demand, but when it comes to just trying to get the deal done, that in itself is also another conundrum that it's hard to finance affordable housing rental project. The amount of layers in the capital stack that you have to secure. So when we
But
say
my point is there's a great demand for that versus that even if he had the funding and the desire, right? Because of the type of housing that's been built in New Haven in particular, and in some of the other surrounding towns, Hartford may be an exception, right? Because Hartford seems that you cannot get anything done unless it's subsidized. But in other places like Stamford, New Haven, Waterbury to much lesser extent, you know, those towns that I figure out to be college towns, right? Or have particular clusters of a particular industry, whether it's biotech, whether it's AI, that is attracting a lot of people. The developers come in. I mean, even the development around Duncan Park, that developer was not interested in subsidies unless the city was insisting that X amount of units had to be low to moderate income. because I know him personally, because, you know, he started in Stanford, then he did New Haven. And even in New Haven, he said, look, I'm not interested in doing those type of units, but if you want me to, then you're gonna have to subsidize it, you know? So I wasn't curious more. You may not have to answer today, you know? But I thought that was a great question that Sarah asked, and, you know, intriguing my mind about, well, really considering what's happening in Connecticut, even if we had another $200 million to do this, besides all the other obstacles that you mentioned, you know, challenges, would there be that great of a demand, you know, because of the type of rental that we're creating? I mean, there's one project in New Haven that one of the apartments was going for $6,500 a month. I mean, we're not going to fund that project.
I think that there's demand for affordability, both in homeownership and in rental. I guess our job is to figure out what mix of the two we provide as a lender, right? And to your point, Commissioner, some people could very well become homeowners because the rents they're paying are higher than a mortgage payment would be, right? So I think if I think of it as a continuum, right, you're thinking of it like people are in rentals and then eventually to become homeowners. You know, maybe there's a way for us to provide the resources and the financing mechanism for those people who want to, can afford to be homeowners, move out of the rental property so that those rentals are now available to people who are looking for affordability in their rental, in their apartments.
I don't want anybody to misunderstand my comment. I'm not saying there is no demand for it. I'm saying how big is the demand? You know, considering the mixture of housing that's been built, and in particular the college towns, right? Or the towns that have a viable university in it, you know, or has a cluster, whether it's biotech, whether it's the AI quantum computer like Stanford does. So I'm not saying that there's no demand. I'm saying how big is the demand?
I think the demand for rent, I
And
think
from the perspective of a developer, right? Because you need a
Yeah.
developer to do it.
I think the rent burden of, so I think of demand as like, you know, sort of, what's the need, I guess? I'm thinking of it in terms of need, like and the need could be quantified in terms of how rent burden the household is, like what percentage of their income goes towards housing payments. And I believe, I will confirm that the rent burden for households, you know, 60% AMI and below is far greater than the housing payment burden for homeowners. So I think that the sufficiency of available inventory in the rental market is far less than it should be. And that's less true for, there is an inventory problem on the homeownership side, but in terms of cost and affordability, I think the rental side has a far greater problem in terms of affordability. So that's just one way of looking at demand and need. I don't know if I helped or didn't help.
Kathy, do you have a question?
Yeah, well, I just wanted to say that the bottleneck in development isn't on the lending side. The bottleneck is on the grant side, because in order to develop affordable housing, the cost to construct, the acquisition costs, the high taxes in most of these towns, and then litigation costs to get housing done in towns that don't want it, make the requirements for grant funding all the greater. So CHFA could allocate an extra $100 million to multifamily, but it probably wouldn't get used because the bottleneck is really on the, you know, having enough of the other subsidies to make the project work.
Jerry, do you have a question, a comment, question?
Comment one, I understand what Nandini and Hazim are saying, and Sarah, it's an excellent question. To some extent, we're constrained by the tax credits, right? Because that's what drives, and also what Catherine just observed, that's what drives development on the multifamily side, right? So we're really sort of constrained there. And you actually look at the resources under our control, we use more ITA and opportunity fund dollars, it looks like, on multifamily than we do on single family. So in some ways, we have our kind of foot on the gas to some extent on the multifamily side. So, we can't lend money if there's not tax credits and there's not grants and they haven't dealt with all the other development issues then you're right, you can't do anything on the multifamily. So it's harder to kind of push against that string. The question becomes, though, is are we supposed to have a non-tax credit lending product for some affordability because we can't lend to market rate? And is that another way we could kind of like ease on the development side? And we've talked about that before, and that's quote unquote workforce, right? So not capital A affordable, but lowercase affordable. That would be really interesting. My guess is, though, if as well as looking, as Sarah suggested, looking at other HFAs across the country and how we allocate between the two, almost what I would be more interested in seeing is for dollars that whether it's bond dollars or ITA dollars or opportunity fund dollars, where we're getting the most bang for our buck. And my guess is it is on the multifamily side in terms of helping people. I don't know for sure. It'd be interesting to see. In other words, how far like if you think about the time to own and down payment assistance, great programs, and I think they're awesome. But like, what impact is our dollar making to people's lives on that versus what impact is a dollar making in an opportunity fund or the investment trust account, right? And then that may tell us maybe how important a workforce type product would be. But just something to think about. It's a really interesting discussion. Thanks, Sarah.
Okay, I don't see any other comments. So may I have a motion for the approval of the resolution for the volume cap?
So
Moved. Second.
Any further discussion? I'll call for a verbal vote. All in favor?
Aye.
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 Opposed? Abstaining? The item passes. Now we're going to our external auditor at Whittlesey to talk about the 2024 audit plan.
Yes, hi, good morning, everybody. For those who don't know, my name is Tom Goldfuss. I'm the partner at Whittlesey. Joining on the call with me today is Katrina Olson. She's a senior manager with us. She's taken over as the day-to-day manager on the audit. We're going to go over the audit plan to you, the communications to have, and Katrina will go over the audit plan in detail, and then we'll wrap up with the recent accounting updates that are effective for CHFA for the year. Is our document available? I know we have a planning document. There we go. So if you want to move through that. Thank you. So as you know, we're here to perform the independent audit of the financial statements. That audit's designed to provide reasonable assurance that the financial statements are free from material misstatement, whether due to fraud or error. We're also tasked with identifying issues and communicating those to management and to those in charge of governance, being the Finance Audit Committee, and then the board as well. We're available for meetings. We'll be communicating the results of our audit at the end to the audit committee and the board, and then work with Allison and her team for implementation of the new accounting standards in addition to our audit work that we perform. The next page is the expectations of management and the Finance and Audit Committee. Management's responsible for the preparation of the financial statements and maintaining the accounting records and schedules. From experience, they do a great job with preparing the financial statements. It's pretty much 100% complete by the time we get it to be able to audit that. So we'll review that, provide any commentary that we may have. We typically don't have much, again, because of the completeness that we're provided when we do that audit. If there were any adjustments or errors or discrepancies, they would be in charge with correcting that. This is our third year engaged with you for the audit, and we haven't had any of those instances happen in the past, so we certainly don't expect them this year, but if they were to happen, that would be management's responsibilities. Management's in charge of keeping the commitment to promote honest and ethical behavior within the organization, and providing us all the information that we request as part of the audit. At the end of the audit, we'll ask them to sign a representation letter that confirms that they've complied with our requests and that they've provided us all the information that we need. As far as the Finance and Audit Committee, the main tasks there are for you to set the tone at the top and promote the high ethical standards of the organization, communicate any significant matters to us that may have an impact on the financial statements, provide feedback to us with our scope on the planned execution of that audit. So that would be through this meeting or separately. Our email address and contacts are on the next page, and we welcome feedback, one-on-one or in this meeting. If there were any alleged or suspected wrongdoings during the year that came to your attention, you would be required to communicate that to us. Again, I wouldn't expect it necessarily in a meeting like this, but you have our contact information to reach out to us and report that. And finally, any concerns regarding the timeliness of the time of the audit or any of the work, please reach out and communicate to us. We've done our independent work, checking for independence internally to ensure that we maintain our independence at the beginning of the audit and throughout the audit. We are communicating to you that we are independent and thus able to provide the independent auditor's report on the financial statements. I don't anticipate that changing at all. It can't really change, so we'll make sure we stay independent, but any independence issues would get reported to you as well. The next page is a summary of our engagement team. And again, I think very important for everyone to understand. Just want to make sure it's on the screen. There you go. We provide the high-level employees of the engagement to you, emails and phone numbers, again, so you have this for your reference on who to contact if there was ever any questions. Obviously, I have myself here. Lisa Wills is in charge of our nonprofit and government practice within the firm. She's also an audit partner for the firm, and she performs the concurring review of the audit. So once I've reviewed everything, then Lisa will also review certain areas. So you have two partners reviewing. Katrina Olson, as I mentioned, is the senior manager. Naomi Haina is another manager that we have due to the size of the organization. Her focus is more on the compliance side of things. You have state and federal single audit work to be completed, as well as the government auditing standards reports that are issued with our audit. So she really runs that and focuses on there. Although I will add, Katrina does have lengthy experience in that area as well. But we'll take as much resources as we have to complete the audit and welcome these two managers. Julianne is our supervisor, and David is our senior. And both Julianne and David have been on this from the beginning. So they are definitely familiar with CHFA and how to complete the audit. And then I will turn it over to Katrina, and she'll walk you through the timing and the audit plan. Katrina, I think you're on mute.
Might be some audio issues.
Is that our end or is that on Zoom's end?
Hear everyone else.
Yeah, we can hear everybody else.
Is it Katrina?
Yeah, it says I'm not muted.
There you go.
Yep.
Oh, wait, now we
Oh, there. Do you hear me now? Okay. Sorry about that. It shows unmuted, so I'm not sure what happened there. All right, so we're good now. All right, thanks, Tom. Sorry about that. Nice to meet everyone. I think as Tom alluded, just to quickly introduce myself, I have been with the firm my entire career, which is 22 years, and I've had a practice focus in nonprofit and government organizations during that time. So I'm definitely looking forward to joining the audit team for CHFA this year. So I'll just quickly run through a few things, kind of the usual spiel that I think you all are interested in. So audit timing, we're actually already underway. We started our planning and interim risk assessment process in early December. So we're working closely with Allison right now as we go through the planning. Our year-end procedures are scheduled for February 24th. So that's when we'll complete our substantive audit procedures and any tests of details and compliance. Just the next page, please. So Tom kind of already touched on our responsibilities under professional standards, but I'll just reiterate, we did have a 3-year engagement letter that was signed back in 2022. We did send a letter in December of 2024 to reaffirm our responsibilities under professional standards, which is to express an opinion on the financial statements that they're fairly presented in accordance with GAAP in all material respects. So we do also perform our audit in accordance with government auditing standards I wanted to highlight. So that's in addition to generally accepted auditing standards. So under government auditing standards, we do issue a separate letter covering internal control over financial reporting and compliance. And if we did identify any significant deficiencies or material weaknesses in internal control over financial reporting or compliance, we would report those to you. And we do, as Tom mentioned, perform the federal single audit in accordance with the uniform guidance, and also the state single audit in accordance with the State Single Audit Act. So it's just important to emphasize that our work does not relieve management or the board of their responsibilities for the accuracy of financial reporting. So the next section, talking about the planned scope of the audit, there at the bottom. So we examine on a test basis evidence supporting the amounts and disclosures. We have to use judgment about the number of transactions to be examined and the areas to be tested. We do assess risk of material misstatement and then design our testing accordingly. So material misstatements could result from errors, fraud, misappropriation of assets, or violations of laws or regulations. If as a result of our audit procedures, we generally communicate any significant findings at the conclusion of the audit, but if we did come across something significant, we would bring that to your attention right away. We do use our audit approach takes a top-down and risk-based approach. That means we focus on areas of higher risk and perform more limited testing on lower risk areas. Just the next page, please. So we use materiality as a tool to determine the extent of our testing of particular line item or transactions. Where possible, we will leverage the work of the internal audit group there to increase our efficiency. Analytical procedures are used to identify trends or any anomalies that might require additional testing, which we use that more in lower risk areas. But the bulk of our testing is substantive testing. So that focuses on testing year-end account balances, confirming balances with third parties and testing general ledger reconciliations. Tom already mentioned fraud risk, but I'll just reiterate that fraud risk does remain a key focus throughout our audit. So we inquire of management, the committee, others in the organization about their views of fraud risk, any knowledge of actual or suspected fraud. And then we'll inquire about any other communications, such as from regulators or whistleblower matters. We do look at related party relationships. So one way we do that is understanding the conflict of interest policy and how compliance with that policy is being monitored. We also inquire and look for any significant unusual transactions in accordance or during our audit planning. So the next slide, please, or the next page. So this page just goes over a few of our key audit areas. I'll just touch on some of these in the interest of time, but one of the most key areas of focus is, of course, the federal and state single audit, where we identify major programs, test compliance, and requirements that have a direct and material impact to the major federal or state program. We also look at identify internal controls over compliance and test those controls. I wanted to mention for this year, the Build for CT program is in the scope of our testing for single audit, along with Time to Own and some other programs. So we do perform walkthroughs over key controls to help us evaluate and lower control risk. We look at the risk of management override of controls and primarily test that via looking at journal entries. In terms of investments and interest rate swaps, we do confirm balances. We test the valuation of those items. Loans receivable. So we'll obviously spend a lot of time looking at the loans receivable, testing, reviewing the policies, underwriting policies, and also the allowance for loan loss. For outstanding debt, we'll confirm the debt obligations and look at compliance with loan covenants. And then with revenue expenses, we use analytical procedures here to kind of find the area of focus for our more detailed testing. All right, with that, I think the next slide is some discussion of recent accounting pronouncements, and Tom's going to touch on that briefly.
Yep. So this should be fairly quick. The probably most impactful standard change to CHFA for the year was effective January 1st. In that regards, that's over compensated absences, and it was a little bit of a bigger standard than maybe initially thought on our end or out there, which required recording liabilities for compensated absences and looking at it from really a bigger perspective. And actually the increase in liability, I think, was higher than anticipated for some organizations. However, Allison and I and Katrina looked through this during the year. We found some ways to implement this, and I think that the impact was not significant. Even the full impact potential probably wouldn't be material, but we were able to work through the standard update. And I think Allison's created a policy. I don't know if it's been approved yet, but I think there's a policy of how the accounting will happen and limit that potential liability. I think the scope of that standard really inflates some liabilities for organizations for compensated absences without getting too technical. But there's some ways around it to limit the impact of it, to make it more realistic to what the actual liabilities that ultimately would be paid, to have that reflective. So I guess at a high level summary, I would report that that I think we worked well with Allison, and that she came with us with the calculations and how she wanted to present it. We bounced it around a few times, and ultimately I think we got to a good spot where going forward it'll be easy to do, and there won't be a significant impact to CHFA with this. The other ones on here are more some technical changes. I'd say 99 and 100 are really technical things that don't really come into play day to day. And then 102 and 103 are more narrative disclosure types of changes with the standards, which will affect the management discussion and analysis within the financial statements, and then in supplemental information. So I don't expect a tremendous amount of effort on the accounting side from the day-to-day, the general ledger maintenance. However, there'll be some additional work on the MD&A and probably some supplemental disclosures going forward. And then the final one, 104, I think is fairly new, so we really have not gone into depth on that one. But I'm sure by the time we report back in later this winter, I guess in March, we'll have more information on that. But that's a newer one. overall, not a lot to impact CHFA for the year. Certainly not like the lease standard was a few years ago, which was more impactful, I think, for organizations. But again, I think that Allison is on top of the standards anyway, and she reaches out when there's questions on the new stuff. So happy to answer any questions anyone has about the timing of the audit, the work. Any other questions for us?
Well, it sounds like it's pretty much the same as last year, other than these GASB pronouncements. Is there anything else you'd highlight that would be different from last year?
Yeah, so from year to year, the procedures change and what we do and what we focus on. I mean, the big picture of the audit doesn't change, but things like related party transactions are more of a focus lately. Certainly journal entry testing, which relates to management override of controls. And then in general, there's a certain rotation of specific general ledger accounts or line items that we look at, but the overall auditing doesn't change much from year to year.
And then a quick question on CHFA has a lot of interest rate swaps, and I know you say you use a third party to do the valuations. Who do we use to do that?
We use BLX.
Okay.
Mm-hmm. Yeah, so our main work there is the main work is reviewing those reports and then evaluating the competency of BLX, which BLX is a very competent organization, very trustworthy. But we need to understand what they're doing, and we'll look for the SOC reports for them as well, which are their auditors auditing their systems, so that there can be reliance on that.
Commissioner Perez?
I was curious, and if you touched on this, I missed it. Do you do any kind of checking on our IT cybersecurity protocols?
Yes, we do.
Can you talk about it a
We have
little bit, please?
specialists internally that they're Will's employees. Their day-to-day job is strictly around IT issues, from computers to mainframes, servers, and then cybersecurity issues, as well as other things. So we use them, we leverage them as part of this audit to, at a minimum, understand the IT controls over financial reporting, but we also ask them to go a little bit deeper and touch the surface on some cyber issues and some security things, just for an additional layer of comfort. They don't do a full scope IT audit, they touch on certain IT aspects.
I'm happy to hear that, because I don't have any specific concerns, but I'm the banking commissioner, and I can tell you we have a lot of issues, and all you have to do is read the newspapers.
Oh yeah.
And I'm not so much concerned about the financial statements, because I'm very confident they're good. I'm more concerned about, the data we have of people, and if that ever gets breached, the reputational risk to the agency, never mind the liability,
Yeah, that's why, like I said, our only audit requirement is with regard to the financial reporting system, but we ask them to go a little bit deeper to look at some of those higher level things because of the potential liability and impact that a breach.
And that's why I stated I'm happy to hear that you're doing that.
Right.
Any other questions? Thank you, Tom. And let's go on to our financial reports. Allison Murphy.
Good morning. Before you are the December financial reports. I do want to point out that these are only preliminary. We are still making some additional year-end adjustments, and probably will be up to the point where Tom and his crew come out in a few weeks. On the revenue side, mortgage loan and investment interest revenue are coming in $34.3 million above budget for the year and $41.5 million higher than last year. The year-over-year revenue variances continue to be driven by the increase in investment interest income due to our current interest rate environment. Fees and other income are $10.2 million higher than budget through year end and $8.9 million higher than last year. As I mentioned in previous months, the large increase in our single family production that we've experienced this year is a big driver of this change. On the expense side, bond interest expense is 18.7 million above budget through year end and 33.7 million higher than last year. The authority's outstanding bonds as of year end were 635 million higher than the same time last year. Servicer fees are 10.9 million above budget and 7 million higher than prior year. And the increase in single family production is driving this variance. Administrative expenses are coming in 7.1 million below budget and 405,000 lower than last year. Excluding salaries and benefits of 29.2 million, our current year expenses are 224,000 lower than last year. And then lastly, the change in net position is above target by 19.1 million. Are there any questions?
Well, that's just amazing, that bottom line there.
Yeah.
So we budgeted 19 million, last year was 18 million, and this year we did 38 million. That's just amazing.
Mm-hmm. Yes.
That's
Good year.
First of all, it's plowed back into our mission.
Yes.
Yes. Any questions for Allison on these very good fiscal year reports? You guys have a different fiscal year. Okay. On to John Chilson, production and delinquency reports.
Good morning. For the month of December, the authority purchased 200 single-family loans totaling $58 million, of which 196 loans were securitized for a total of $57 million. The average loan balance in December was $290,500, which is 15% higher than the December 2023 average balance. The loan production for all of 2024 was 3,868 loans totaling $1 billion, which is 33% greater than the stretch goal for the prior year. For all of 2024, the mortgage-backed security balance grew by 31%, or $822 million, ending the year with a $3.5 billion portfolio balance. The whole loan portfolio through the year, at least through end of December for the 12 months, declined by 500 loans, or a little less than $68 million, ending with a portfolio balance of $1.1 billion. The delinquency rate was 5.9% at the end of December, which was consistent with the state and nationwide averages. And the carrying balance for loans and foreclosures year over year increased by $1.4 million to $13.2 million, with the total number of loans increasing by 8. For the month of December, the authority also funded 92 down payment assistance loans totaling just about $1 million, the average loan size at $10,800, and then 233 time to own forgivable loans totaling $5.5 million with an average loan size of $23,600. And on our multifamily side, there were 8 loan closings in December. The portfolio, multifamily portfolio for 2024 grew by 22 loans, ending the year with 602 multifamily loans totaling $1.4 billion. And in December, there were 8 permanent loan multifamily delinquencies and no construction loan delinquencies. And the overall delinquency rate for multifamily portfolio was just about 0.5%. Any questions?
Hearing no questions, let's go on to our investment and swap report. Ningyoung Lee.
Morning. The investment report reflects an overall increase in book value by 174 million to 4.6 billion, and an increase in program assets by 206 million to 3.5 billion. Quarter over quarter, the weighted yield to maturity for the investment portfolio decreased slightly from 4.24% to 4.22%. The swap report has a hedging position of 867.67 million notional value. This is a 10.49 million decrease from last quarter due to amortization. There are currently 41 swaps with 8 counterparties. Compared with last quarter, the weighted pay rate by the authority decreased from 2.934% to 2.898%. Mark-to-market value increased from 24.36 million to 58.3 million. I'll be happy to answer any questions.
My impression is that our overall swap portfolio has been trending down. Is that true, Hazim? Used to be over.
Yes. Yeah.
And that's
Because
go
we-
ahead.
Because we haven't been issuing variable rates and adding new swaps, and the swap is just through amortization, just paying down.
And that's because of market conditions. Sometimes you need to do the synthetic fix to get your spread or whatever.
Yes, and since you're mentioning it, I did mention to your staff when we're doing the state's due diligence. We would be looking we will be considering variable rate bonds along with swaps due to the amount of the private activity cap that we received for this year, in terms of trying to ensure we will be able to continue to offer below market interest rate for the single family program.
That's to compensate for having to issue taxable bonds.
Yeah, well, we will still need to issue taxable bonds, but because we are relying more on taxable bonds, the cost of capital will go up. So we need to mitigate a portion of that increase in capital costs.
So you'll be entering into new swaps, you anticipate.
Potentially, like you mentioned, is essentially market driven. But based on the lack of, or the smaller size of tax exempt debt, that's on the table as a potential solution.
Okay, any other questions on this report? Let's move on to Joyce Campy for our internal audit report.
Good morning. I wanted to provide you with an update on the audit activity in the fourth quarter of 2024. Starting with CHFA audits, our audit focus in 2024 has been on the back end of the home ownership business functions. So it's functions performed by finance portfolio management. So at the beginning of the year, we focused on loan purchases, the pooling of loans, and the purchase of MBSs. So in this quarter, we also did the review of loan payoffs. The function processes funds received from servicers for the payoff of first and subordinate mortgages received prior to the maturity of the loan. The majority of audit recommendations were implemented during the review and primarily all related to system processing, which did not have a material effect on the accuracy of the payoff. Switching now to multifamily, we completed a follow-up audit of the allocation of the HTCC funding round. The scope of the review was a sample of applications from the 2024 funding round, and our test work focused on ensuring that recommendations from the original report were implemented. Results concluded that all prior audit recommendations, 25, were implemented. Detailed audit reports for these two reviews are attached to this report. Turning now to servicer compliance reviews. The scope of the review includes the servicing and the collection functions outsourced to homeowner mortgage loan servicers, and typically we're looking for compliance with contract terms and insurer guidelines. So now I'd like to give you an update on a review that's in process. So during the period, we completed a servicer compliance review of Norcom Mortgage and issued a review letter. As a frame of reference, the servicer services approximately 11% of the authority's homeowner first mortgages, which is about a loan balance of $135 million. We had a number of audit review conditions identified during the review, and including that borrower's custodial escrow bank account was underfunded by between approximately $611,000 to $1.3536 million in the March to December 2024 timeframe, and that reconciliations between the bank account and the servicer's loan level records were not being performed. I do want to stress that servicer management is working on correcting these issues. However, at this point, we have not received a written corrective act.
And rescinded a direct
a written corrective action plan. Our evaluation of management's actions is pending this review of this action plan and the supporting documentation required to close these items. We have been providing updates to CHFA management and will continue to follow up with the servicer in 2025. So when we discuss the 2025 plan, you will see a follow-up audit, a follow-up servicer review, and for this servicer. And in terms of advisory and other activities, we've completed a limited scope review of the process controls and documentation for Build for CT, administered by the authority based on an MOA with the Department of Housing. The program provides financing to multifamily properties to create housing units affordable to the middle income households. Overall, we made a recommendation to multifamily to work with CHFA and DOH Legal to update the MOA to clarify loan submission and reporting requirements, as well as additional tasks which will be required to be performed, such as compliance monitoring of program units. We had one add to plan at the request of the CEO to review certain homebuyer loan files for compliance with various program guidelines. And as previously mentioned, we have been working with IT to implement a new audit software package. And during the period, we selected the system for staged implementation beginning in 2025. I have included in the board write-up the audit chart, which lists all of the audit activity completed for full year 2024. Lorraine, if you could advance the slides. Moving on to 2025 internal audit plan. In developing the plan, we used a similar methodology that I have discussed with you in prior years. Annually, we review top risks associated, likely to affect organizations worldwide based on audit guidance. We discuss key business priorities, risks, and changes with management, and we update our segment level risk assessments. Based on this analysis, we come up with an audit plan. We may defer certain segments if they're undergoing business or technology changes, or for example, changes in service organizations. The audit then becomes a subset of audits, CHFA, from the CHFA portfolio, cyclical compliance reviews of select servicers from the servicer portfolio, as well as planned advisory services at the request of management. We review the plan with management to ensure coverage aligns with their goals and objectives. And then throughout the year, we may assess and modify the plan based on factors such as changes to business priorities, staffing resources, and servicer availability. So with that said, I'd like to discuss with you the 2025 internal audit plan for your consideration. In terms of home ownership, we're going to continue to focus on additional processing functions performed by finance portfolio management. Audit coverage will review internal controls over investor reporting and collections from mortgage loan servicer. That is basically a UPB by UPB between the two systems comparison, and then a comparison to the cash receipt. And secondly, the monitoring of loans to the loans in the delinquent and foreclosure status. The scope of these reviews will include new system implementations. For the multifamily business, we'll continue our coverage in the HTCC program. With the completion of the allocation done in 2024, a follow-up review of compliance monitoring of the program has been scheduled. And then as time allows, an audit of costs certainly may be considered in the multifamily area. An audit of internal controls over payroll performed by human resources will also be completed. As you know, salaries represent about 40% of the 2025 operating budget, In that engagement, we also look at the payment of benefits to the state of Connecticut as well. Turning to servicer compliance reviews, the plan includes 3 loan servicers representing approximately a third of the homeowner first mortgage loan portfolio. Amerinet, C4C, and KeyBank, as well as a limited scope review of the servicing performed for a portion of the authority's down payment assistance loan program. That is, those performed by C4C, which is about 43% of the total. In that engagement, we will also look at the servicing they perform for the time to own loans. Based on the 2024 audit results, as I've just mentioned, we have added follow-up reviews of 2 servicers as their action plans are implemented, required by management. The plan also lists advisory services known at this time, which include the monitoring implementation of IT security controls, which have been incorporated into the 5-year technology strategic plan to further mitigate cybersecurity risks and enhance controls. Those are called CIS controls, and those are being implemented by IT. And we also participate as members of various authority-wide committees. This year is the threat management team, which has been created as part of the authority's emergency operations procedures. Any new activities will be disclosed throughout the plan period. I have included in your package a chart listing all of the 2025 activities. And with that, I'd be happy to answer any questions.
Very thorough and comprehensive. How big is your staff, Joyce? How many staff members are in the internal audit department?
I have 2 full-time staff members.
Okay.
And to assist with servicer compliance reviews, I have a retired rehiree who works on a part-time basis.
Oh, well, looks like you got your work cut out for you. Any questions from anyone on the audit plan or last year's audit? Seeing none, we'll move to approval of the minutes for the last Audit and Finance Committee meeting, November 21st. May I have a motion?
So moved.
Second,
Second.
all in favor, say aye.
Aye.
Aye. Opposed, abstaining, the minutes are approved. Well, thank you, everyone, and I'll entertain a motion to adjourn. All in favor, say aye.
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 Thank you. See you on the other side.